Okay, right now, if you're an NRI making $150,000 in Silicon Valley, you could be hemorrhaging $15,000 to $25,000 annually in avoidable taxes. And most of you don't even know it's actually happening. Here's the brutal reality. The IRS wants its cut of your global income. India wants its cut of your Indian investments. And without proper planning, you're paying both, sometimes on the same dollar. But here's what the tax advisors charging you $500 an hour don't tell you, that there's a legal framework to optimize this. You just need to know how to play the game. Hi there and welcome to Americanomics. I'm your host Akash Bhatt, and on this channel, I make content that helps NRIs living in the US better understand topics like visa, building wealth, navigating careers in academics, along with some tidbits on leading a happier life. And I'm extremely thrilled to share that we are now part of the 01 network by Zerodha. Here's a fun fact. Indian Americans filed over 400,000 tax returns claiming foreign tax credits just last year. Yet, according to the IRS data, less than 30% maximize their treaty benefits. That's leaving money on the table, and lots of it. Most NRIs I know fall into one of these traps. They're double taxed on Indian rental income. They're paying 30% TDS on Indian investments instead of treaty rates. They're not claiming foreign tax credits properly. And they're also mixing up NRE and NRO strategies and getting hit with unnecessary withholding. The US-India Tax Treaty isn't just a document. It's your roadmap to keeping more of what you actually earn. Okay, so today in this video, let's break down the 4 biggest mistakes NRIs make. Mistake number 1, not getting a Tax Residency Certificate, or in other words, TRC. Without a TRC from the IRS, India treats you as a non-resident and slaps you with a 30% TDS on everything. That's dividends, interest, and rental income. With a TRC, you can claim treaty rates, 15% on dividends, 10% on interest, and 25% on rental income. Getting a TRC is extremely simple. File Form 8802 with the IRS, pay $85, and wait 45 days. That is it. And this can actually save you thousands of dollars annually. Mistake number 2, wrong account strategy. Here's what most people don't understand. The NRE versus NRO isn't just about repatriation, it's about tax efficiency. Let's talk about the NRE accounts first. Interest is tax-free in India, fully repatriable, but you only can deposit foreign income into it. On the other hand, an NRO account, you can deposit Indian income, but the interest is still taxable, and repatriation is capped at $1 million annually. So what's the hack here? If you're earning rental income in India, route it through an NRO. But if you're sending US salary to invest, use an NRE. Many NRIs mix this up and unnecessarily end up paying a lot of taxes. The third mistake, not timing your residency status. Here's something your CA probably has never told you. In India, you can choose to be a resident or an NRI for tax purposes in certain transition years. So let's assume that you moved mid-year to the US. You might actually qualify for resident but not ordinarily resident status, which technically means Indian tax only on Indian income. So you end up saving massive amounts if you have US stock options vesting or bonuses that are hitting. So what is the key? File your tax returns strategically in the first few years when you're living abroad. Mistake number 4, ignoring PFIC rules on Indian mutual funds. And this can be extremely brutal. The IRS treats Indian mutual funds as PFICs, or passive foreign investment companies. The tax rate up to 37% plus interest penalties on gains. But here's some good news for you. There's a workaround. Instead of direct mutual fund investments, use Indian ETFs traded on US stock exchange, like INDA or Mindex, or simply invest through your NRO account if you're planning to stay long-term in India. Now, here's the smart NRI tax strategy that most people don't really know. First up is residency planning. You've got to time your moves between the two countries to optimize your tax years. Amount optimization. Use NRE for investments and NRO for Indian income. Next up are the treaty benefits. Remember, always get your TRC and claim appropriate tax rates. And investment structures. Avoid PFICs if possible and maximize foreign tax credits. You must also find a CPA who understands both the systems. Expect to pay anywhere between $2,000 to $5,000 annually, but remember, the savings can be anywhere between $10,000 to $25,000. Look, taxes can be extremely boring. But losing 10 to 25% of their wealth to poor planning, well, that is a tragedy. In fact, a cardinal sin if you ask me. You did not move to the US to fund two tax systems. You actually did so to build wealth. And the tax code is complex. But the strategy here is extremely simple. You've got to plan ahead, use these treaties to your advantage, and stop leaving money on the table. Because every dollar that you save on taxes is a dollar that potentially compounds into your future. This is Americanomics, where we turn tax complexities into wealth opportunities. Hit that subscribe button if you save money and drop a comment with your biggest tax question. I will try and answer as many as possible in the next coming days, and most importantly, we've got more such videos lined up for you, so make sure that you tune back in again. I'll see you in the next video.